On January 15th, 2026, at 6 a.m. Eastern Time, BlackRock publishes one number: $14,041,518,000,000 in assets. In the same release, another number appears: $698,261,000,000 of net inflows across the year. And while the public fixates on the headline number 2.1 trillion, something quieter is happening. Positions are being reweighted. Exposure is being redistributed. Risk is being reorganized. Because this isn't about leaving America. It's about how global capital survives the next phase. And if you're a retirement saver, a homeowner, or building wealth in your working years, this changes everything. What if everything you believed about where smart money stays was wrong? Let me show you something. Once you see this pattern, you can't unsee it. This unfolds in 4 stages. I call it the capital gravity cycle. Stage 1. Productive dominance. The core economy builds what the world must buy. Stage 2. Leverage expansion. Debt grows faster than output because growth is financed. Stage 3. Financialization. Returns shift from producing goods to owning assets. Stage 4. External rotation. Capital starts looking outward quietly, institution by institution. Throughout the last 500 years, every major financial center follows the same sequence. The timeline varies. The sequence never changes. This isn't prediction. This is pattern recognition from centuries of balance sheets, debt cycles, and capital flows. Stay with me, because by minute 8, you'll understand exactly why 2.1 trillion is a warning label. Here's what most people miss. Markets don't announce regime change with a siren. They signal it with allocations. When institutions feel a shift in the cost of capital, they don't panic. They rebalance. They shorten duration. They diversify jurisdictions. They buy ups. And when the largest asset manager on earth reflects those preferences, it's not a headline. It's a map. Remember the 4 stages. We're going to walk through proof, not opinion. 3 historical systems. Hundreds of years. One identical cycle. Start with the Dutch Republic, the first modern experiment in global finance. In 1609, Amsterdam builds an exchange bank designed for trust, settlement, and stability. This is stage 1 thinking. Build a system the world can rely on. Then stage 2 arrives. Leverage expansion becomes policy. By 1700, the province of Holland carries roughly 140 million guilders of debt. A century later, that figure climbs to around 380 million guilders. Stage 3 follows, and it looks like sophistication. The economy becomes a portfolio. By the late 18th century, public debt is described in the hundreds of millions of guilders, and foreign assets become a defining feature of elite wealth. This is textbook stage 4. When the home system matures, capital stops needing home to generate returns. It needs safety, yield, and exit doors. But that was just the beginning. Let me show you what happened next. The Dutch system didn't collapse in one dramatic moment. It thinned out. Influence moved. The gravity shifted. And that is the point. Stage 4 is rarely a crash. It's a migration of incentives. When leverage is high and returns are concentrated in assets, capital becomes more selective. It starts to ask one question: where can I preserve purchasing power when the rules change? Now let's move to the next empire. Same pattern, same stages, same outcome. Britain. Sterling. Industrial dominance, then debt, then financialization, then forced adjustment. Stage 2 is visible in hard numbers. In 1815, at the end of the Napoleonic Wars, British government debt is near £1 billion. That is more than 200% of GDP. Stage 3 intensifies after global war. By 1946, British debt is around £24 billion, roughly 250% of GDP. Then stage 4 arrives with external pressure. On September 18, 1949, sterling is devalued from $4.04 to $2.80 per pound, a devaluation of about 30.5%. And in 1956, During the Suez Crisis, emergency funding runs into the hundreds of millions of dollars as reserves and credibility are defended under pressure. The timeline varied, but the sequence never changed. When debt and financialization mature, the currency becomes a geopolitical instrument and a geopolitical vulnerability. Notice what didn't matter. It didn't matter that Britain had prestige. It didn't matter that Britain had history. Stage 4 doesn't care about pride. Stage 4 cares about math. How much financing is required, at what cost, and from whom. Now the third system, the one you live inside, America's dollar era. Stage 1 is productive dominance. The United States builds the post-war industrial core. Stage 2 grows across decades. Leverage expands in the private sector and the public sector because the system is large and global. A structural turning point hits on August 15, 1971. The U.S. suspends dollar convertibility into gold. The architecture changes. The constraints change. Stage 3 hardens in modern crisis management. On October 3, 2008, the United States authorizes $700 billion for the Troubled Asset Relief Program. Then, Stage 4 becomes visible in the balance sheet era. The Federal Reserve expands assets to the scale of multiple trillions, then begins to reduce them. By the week ending January 21, 2026, total Federal Reserve assets are about $6.585 trillion. 3 systems. Hundreds of years. Identical cycle. Now, let me show you why this matters right now. Today, to you personally. Here's where we are in the cycle right now. First, the headline. BlackRock moved to $0.1 trillion out of America. The problem is that this claim confuses a category with a direction. $2.1 trillion is not a single giant outbound transfer from the United States. It is a measure of institutional active assets under management, what pensions, insurers, and sovereign-style pools allocate into mandates where risk is intentionally engineered. Now, listen to the numbers that actually define today's positioning. As of December 31, 2025, BlackRock reports total assets under management of $14.041 trillion. In 2025 alone, it reports $698.261 billion of net inflows. Those flows are not an America exit. They are a rebalancing across products, durations, and regions. In the same reporting, regional long-term net flows include roughly $190 billion in the Americas, $86 billion in Europe and adjacent markets, and a negative figure in Asia-Pacific. That's the first clue. This is not a stampede. It is a portfolio decision. Second, look at what kind of assets absorb demand. BlackRock reports around $1.08 trillion in cash management assets. Cash is being treated as a strategic allocation, not dead money. It reports more than $322 billion in private markets assets. Private credit and private equity are where institutions seek yield without daily market noise. It reports more than $78 billion in digital assets, not because it is the center of the system, but because it is now part of the system's optionality. Third, the sovereign backdrop matters. As of January 22, 2026, U.S. total public debt outstanding is about $38.49 trillion. That number is not politics. It is financing reality. When debt is that large, funding conditions become a national variable. And here is the key connection to the pattern. Stage 4 requires outside capital and inside discipline. When a mature reserve system needs continual bias, the market becomes more sensitive to yield, credibility, and inflation risk. The risk-free asset changes behavior. If you're 30 to 55, this affects you because retirement portfolios are built on a quiet assumption that bonds will stabilize risk assets when conditions deteriorate. But when issuance rises and investors demand compensation for duration, bonds can become a source of volatility. Some will say this time is different. Here's why it's not. The Dutch had trust and banking innovation. Britain had empire and sterling. America has the dollar and the treasury market. In every case, once leverage and financialization mature, capital begins to diversify. Not because it hates home, because it follows incentives. Based on this pattern, here's what happens next, over the next 12 to 24 months. This isn't fear. This is preparation based on historical precedent. Warning sign 1. term premium stress, watch long-duration yields, and auction demand. When buyers become price-sensitive, borrowing costs become policy constraints. Warning sign 2. Portfolio redefinition. If long treasuries stop acting like ballast, allocations shift toward short-duration instruments, cash, gold, and private lending. Not as ideology, as risk management. Warning sign 3. Institutional outsourcing accelerates. When complexity rises, large pools hand more discretion to mega platforms. That 2.1 trillion category grows because institutions prefer engineered outcomes, not raw exposure. For retirement accounts, for savings, for home affordability, this matters because the cost of capital sets the cost of life. Mortgages, corporate borrowing, government, policy, everything. Reference is the long end. If capital continues rotating globally, America remains powerful. But the terms of financing become less forgiving, and there is one personal truth beneath all of it. You do not control macro cycles. You control your positioning within them. Stage 4 does not demand panic. It demands clarity. It demands that you understand what institutions are preparing for, even when they don't narrate it publicly. Here is the thesis, in plain language. The 2.1 trillion number is not BlackRock abandoning America. It is the signal of Stage 4. Institutions paying for global diversification, liquidity control, and outsourcing at scale. You have a choice. Understand the pattern and position accordingly, or ignore it and hope this time is different. But remember this, time is never different. The pattern is absolute. If this analysis opened your eyes, subscribe now. In my next video, I'll show you the 3 indicators that reveal when a currency system flips from dominance to dependency. Before the mainstream calls it, the capital gravity cycle is coming. The only question is whether you'll see it before it arrives.